Hi, my name's Ivan from Scholes Chartered Accountants. I'm going to talk today about SIPPs, self-invested personal pensions, just to give you a bit of an overview of what they're all about. So, what is a SIPP? Well, it's a private pension which gives you a higher degree of control over how your pension funds are invested than with traditional private pensions. So, money invested in SIPPs can be invested in a variety of places, both traditional things like stocks and shares and bonds, but also a variety of other types of investments such as commercial property, for example. So I think it's really important to appreciate with a SIPP, you are assuming a greater degree of control, but also have greater responsibility for managing the investments in there than with an ordinary private pension. With SIPPs, you have a lot of the same tax advantages you do with other more traditional types of pension. So, for example, you're getting tax relief on the contributions you make up to the extent of your earnings. So, for somebody earning and paying tax at the basic rate, for every £80 you put into the pension, the government will add another £20 as tax relief. And if you're a higher rate payer, actually it's going to cost you only £60 to put £100 in there, because higher rate payers can claim the extra 20% tax relief through their self-assessment return. So all the tax advantages you get with any other kind of ordinary private pension. One of the particularly interesting things I think for small business owners is that with a SIPP, it offers a possibility of using your pension funds to invest in commercial property. And I've seen in many cases small business owners will use funds held in a SIPP to acquire a commercial property from which they operate, from which they trade. And of course the point of that is that it's a very tax efficient way to structure things, because typically the business then pays rent to the SIPP who owns the commercial premises. That rent is tax deductible for the business for income tax or corporation tax purposes, and of course the rent received by the SIPP it accumulates and is invested tax-free, because SIPPs, in common with other kinds of pensions, the funds invested within the pension don't attract taxation, no corporation tax, no capital gains tax. So there are limits in terms of how much you can contribute into SIPPs in common with other ordinary defined contribution schemes. And normally, in terms of the tax relief you will get, it's limited to your earnings in the tax year. But even if you're a non-earner, you can still contribute up to £3,600 gross to a SIPP each tax year, gross meaning including the 20% that the government add back. It is important to be aware of the annual allowance. So there is an annual maximum which can be contributed to a SIPP. Ordinarily that's £40,000, but it is capped at lower amounts, both for high earners, very high earners, and also for people who are already flexibly accessing benefits from one or more other pension schemes. And you don't want to contribute more than that annual allowance, because pretty expensive tax charges apply if you do. And there's also a lifetime allowance these days in terms of the maximum you can have in your pension pots. Overall that's capped at £1 million these days, so you've got to be aware of that too. In terms of getting a SIPP going, you can either start one from scratch. Alternatively, it's possible to transfer funds from an existing pension that you already have across into a SIPP. When can you take your money? Well, generally speaking, with pensions these days, age 55 is normally the minimum age from which you can start to take pension benefits. There are many circumstances where people choose to delay when they take the money. All the while it remains within the pension, it continues to benefit from the tax-free investment environment that pensions enjoy. But 55 is generally the minimum age. From an inheritance point of view, pensions, and including SIPPs, are quite tax-efficient environments too. So if there is money in a pension pot and you die before you reach 75, these days, generally speaking, that pension pot can be paid out to beneficiaries as a lump sum, free of tax. And if you die aged over 75, then again the pension pot can be transferred, generally free of inheritance tax, to beneficiaries. But in that instance, when they take it out, they'll be subject to income tax at their marginal rate. So that's a wee overview of the self-invested personal pension scheme, or SIPPs. Very, very important if you're thinking about using a SIPP or starting a SIPP. Do take appropriate financial advice from a qualified financial advisor. The point of me talking about this to you today is just to give you a bit of an overview, and I think particularly to highlight that specific benefit I explained there about the small business owner who might wish to buy commercial premises through a SIPP, because that offers quite a tax efficient structure, and we do see quite a lot of small business people in the right circumstances doing that these days. So I've been Ivan from Scholes Chartered Accountants. If you think we can help, get in touch with us and check out our website at www.scholesca.co.uk. Thanks.